Hey everyone, for those of you who don't know me, I'm Andrea. I work with Ruben at the Furtado Group. I just got to the office today and we're going to be sitting down with a mortgage broker who's going to go over some of the most asked questions that I get, as well as what he gets when people are trying to qualify for mortgages. So let's dive in and get right to it. Hey everyone, we're here in the Rockstar office today with Dan Patton.
Hi.
That's with Butler Mortgages. We've been working with Dan, I personally probably for over 9 years now.
Long time.
Yep, so we are going to jump right into it and ask some important questions that we hear all the time when it comes to financing and mortgages.
Yep.
So thanks for getting here.
No problem.
Biggest question I think coming up what are the changes with 2018?
Yep.
Everybody was a little bit nervous come January 1st, how things were going to affect them being approved for mortgages. So
Yep.
I think the biggest question probably is the stress test.
Well, the stress test obviously is the big change that sort of people have been talking about since 2018. And for those that aren't aware of what the stress test is, basically, up to 2018, when you were qualifying to purchase a property or refinance your home and you were taking a 5-year fixed rate, for example, you could run all of your numbers on that 5-year fixed rate. So let's say the 5-year fixed rate at the time was 2.99 and you were trying to buy a property, they would run your assets and liabilities, qualify you at that 2.99% rate. Now, one of the changes the government made starting January 1st was the stress test, which is basically we can't run your numbers anymore at that 5-year fixed rate to qualify. Nowadays, you have to run your numbers at the posted rate, which today is 5.14%. If you're taking a variable, and if you're taking a fixed rate, it's 2% higher than what the 5-year fixed rate is. So that 2.99 rate that you were qualifying on in 2017 is actually now 4.99% if you're taking a fixed rate. So
it's a huge increase.
It's a big increase,
yeah.
And a lot of what I've read was saying that those sorts of changes could affect maybe 10 to 15% of buyers that are out there putting in offers on properties. But what we also found is, and from some of the articles that I've read from Benjamin Tal being one from CIBC, was people are resourceful, and that 10 to 15% that stress test might affect might actually be a little bit lower, because people that are sort of on the edge of qualifying, that may be qualified at 2.99 and aren't qualifying at the 4.99, they'll find co-signers, or they'll come up with additional down payment to make the numbers work. So certainly we will see some level of effect, but people are resourceful, and I don't think the drop will be as dramatic as some of them are anticipating.
Okay, yeah, that makes sense. So in terms of the big banks like Scotia, RBC, CIBC,
Yep.
What are they looking for now when they're qualifying?
Good question. Yeah, pretty standard from what it was before. If you're your typical hourly wage or you're a salaried employee, as long as you're not on probation, the lenders will use the full income. So if you're 2 months into your full-time position, as long as there's no probation, they'll use that. Where the challenge, I guess, sort of starts to come in with the A lenders is the self-employed aspect and the contracting and things like that. It used to be, I'm not sure how many people have been buying here for a long time, but about 5 years ago, 20% down was sort of the be-all and end-all. If you had 20% down, the A lenders would approve you.
I remember that. It was like, if you have 20% down,
right?
You didn't need to worry about anything else. It was just, there's your deal.
Exactly. And that the scope of lending has changed so much, and people tend to focus on a lot of the 2018 changes, which are important because there's been some big ones. But some of the bigger changes that have sort of happened over the last 3 years revolve around the qualifying.
Okay, so what are the big banks looking at when they're qualifying buyers, whether they're salaried or self-employed?
Yeah, well, big banks, so first of all, let's distinguish kind of what the big banks are. When we're talking big banks, you're typically talking your major lenders, so your RBCs, your CIBCs, BMOs, TDs, and Scotias. Now, these guys, when you're self-employed or you're on contract, they still have sort of that standard qualifying. It used to be, again, we said 20% down used to sort of get you past a lot of doors and eliminate a lot of the questions being asked. But again, some of the rule changes the government has made, not just on January, but leading up to January in 2017 and 2016, has sort of put more regulations on the banks to ask for more documents. So for salaried employees or for your typical hourly waged employees, very standard. The bank will consider job letters. They'll look at your pay stubs. If you work overtime, they tend to look at a 2-year history, give or take, of what that income will be. And then when you start to get into the self-employed and contracting, it gets a little bit more difficult. I shouldn't say difficult, I should just say it's a little bit more stringent. They're going to want a 2-year history of you being self-employed, so you have to have either your articles or a business license, and then they're going to look at your provable income, so your line 150.
So in terms of line 150, that's your provable income.
Correct.
Right? So for someone like myself who also is considered self-employed,
Yep.
that's kind of the fine line all the time where I personally, when I'm buying properties, I want to make sure that my line 150 shows enough so that I'm approved usually by
Yep.
these bigger banks.
Absolutely.
Right? So what are other options for people who maybe aren't showing as much
Yeah.
on their provable income?
It's a question we get asked a lot. Obviously, we deal with a lot of real estate agents. We deal with a lot of self-employed, a lot of contractors, subcontractors, and things like that. So this question does get asked a lot. With the big banks, so with your major lenders, again, your TD, Scotias, and those guys, provable income is still going to be paramount to them. They're going to look at your line 150. They want to see your provable income, whether you're self-employed and writing your income down low. That's the number they're going to look at to try to qualify you. One alternate, though, however, that we've sort of seen kind of step up in the marketplace has been B lending. B lending is an alternate to A lending. So again, your A lenders are your typical banks where you're going to get your best rate. They're not going to charge you any fees, but they're going to stick to this sort of qualification rules. There's not a whole lot of exceptions that get made, even with 20% down nowadays. So you're limited to, again, your provable income has to offset the debt that, or the home you're buying, the purchase, along with any existing debt that you have, which sometimes is a challenge for the self-employed. So again, B lending becomes a very popular option nowadays for these sorts of clients. B lenders are different. Yes, they're going to charge you a little bit of a higher rate in comparison to where the A lenders are at. It could be anywhere from 1% to 1.5% higher, and usually there's upfront fees associated with B lending. But where B lending can really help sort of this niche market of maybe real estate agents, subcontractors, is B lending looks at your income differently. So the A lenders are going to look at that line 150 and a 2-year history of what your provable income is.
Right.
A B lender will help create your income from things like invoices, bank statements, a business license that maybe is only active for 6 months. This is the alternate area for buyers to go. Now, certainly when we hear, a higher interest rate and we hear that there's potential fees up front, it sort of backs us off from going to those lenders. But when you compare the two of an A lender versus a B lender, and you compare somebody who's self-employed and showing $100,000 on their line 150 versus somebody who's showing, let's say, $30,000 to $40,000, and they're both qualifying for the same property, one with an A lender, one with a B lender, you can do the numbers yourself and just see what the difference would be in terms of taxes and what you're paying when you're self-employed.
For sure. Yeah, that makes sense. And I think in terms of even if you are paying that higher rate, it's an option that a lot of people don't even feel that they have, right? Being self-employed, a lot of people just feel stuck that they don't have a lot of options when it comes to financing.
Well, and 100%. And part of that is when you do, most people deal with their major banks, deal with their bank that they do their banking with, and they don't have that option. So it's not like you're going to go and sit with an RBC, a BMO, or any of those guys, and they're going to send you somewhere else to an alternate lender, which is where brokers or agents or good agents have those sort of outlets to be able to access deals. You're absolutely right. When we're talking a strict numbers wise and we're looking A lender rates versus B lender rates, there's not a big comparison. But when you're talking about the income you have to claim to go to an A lender versus the income you have to show to go to a B lender, you may find your numbers a little bit more beneficial if you do them.
Yeah, that makes sense for sure. So in terms of down payment, how have things changed in that area?
Well, down payment is still the same. You can still actually qualify for 5% down, 10% down. Anybody here that follows mortgages, we know that when we buy a property at less than 20% down, it's an insured mortgage, meaning it's got to be insured by either CMHC, Genworth, or Canada Guarantee. They're the big 3 insurance companies. But they will do 5% down, 10% down, and even 15% down, all the way up to 20%. Buying rentals nowadays, 20% down is the standard when you're buying rentals. When you go to a B lender and you're buying a rental, they're looking at 25% down. But the same down payment rules still exist. It's just really a question of fitting into that box nowadays because the rules are changing and they're just scaling back the lending practices, I guess.
Right. So I've heard that you are able to get a lower interest rate by putting down 5 or 10% opposed to the more traditional 20%. Is that true?
Yeah, it's funny. I get this question a lot, obviously. When people are buying with 20% down, you tend to think that the interest rate's going to be a little bit lower.
Sure.
But I guess a simple way of explaining it is this. When you're buying at less than 20% down, there's a lot more competition. There's a lot more lenders and banks that are competing for your business. Typically, when you're buying with 20% down or more, you're sticking to the big banks again, your RBCs, your Scotias, your TDs, because those are the guys that are going to offer you 30-year amortizations and best rate at that point. Now, these monoline lenders, they actually used to compete for business at 20% down, and they used to offer 30-year amortizations, and you could sort of have your pick, whether you want to go to a big bank or whether you want to go to a monoline lender.
So what would be an example of a monoline lender?
Well, MCAP, Street Capital are two monoline lenders, and basically they just exist to do mortgages. That's really all they do. It's their bread and butter. They have good call service, they have, good customer service. It's all the same, but really all they do is mortgages.
What would you say the difference is then between a monolender and a big bank like CIBC or RBC?
Yeah, so in terms of qualifying, they're all going to sort of look at your numbers and your income and your down payment the same way, but where they really differentiate is at that 20% down. They all used to do, see, when you buy a property at 20% down, you actually still have access to 30-year amortizations, which is a big benefit sometimes for people because it helps stretch out cash flow, right? So monoline lenders used to actually have that product available. They could do 30-year amortizations just like the big banks. But one of the rule changes the government made last year was they blocked the monoline lenders from doing those 30-year amortizations. So that's not available anymore. So nowadays, when you're going to buy with 20% down, you're almost limited to those big banks because they're the only ones that will do 30-year amortizations at best rate and use the same qualifying as everybody else.
Makes no sense to go anywhere else.
Right, it makes no sense to go anywhere else. Now, where it gets interesting is when you buy with less than 20%, those monoline lenders are still there, and they still aggressively go after interest rates and go after business. So when you take somebody who's trying to qualify at 20% down and you basically fit them in a box with the major lenders and say, this is kind of where you have to go, and then you take somebody who's buying with 5 to 10% down and say, there's a whole sort of surplus of monoline lenders that will aggressively, aggressively go after your business, interest rate is a key part of that. And those monoline lenders know that the only way they're going to get business from those big banks at 5 to 10% down is to aggressively offer lower rates. So yes, to answer your question, when you're buying with less than 20% down, you actually have the advantage of going to different lenders, which could ultimately offer you lower rates.
That's interesting. It almost makes me think about the difference between like a seller's market and a buyer's market.
Absolutely.
The seller's market being big banks, right?
Absolutely.
And a buyer's market with
the monoline.
the monoline and having lower prices.
Yep, absolutely.
I just want to thank Dan for taking the time to come in and share all that information with us. I found it to be super informative, so I hope you did as well. If you like this video, please feel free to like it, share it, leave a comment below if you have any other questions having to do with being approved for mortgages, financing, anything like that. And we will definitely reach out to Dan and get those questions answered for you.